Most real estate investors in the US don't know how to analyze a property in Thailand. Most international investors don't know how to analyze a US property. This framework works for both and every market in between. Real estate return analysis fails when investors apply local formulas to global markets. The investor who applies US cap rate norms to emerging markets overpays. The one who applies Bangkok yield expectations to Detroit buys negative cash flow property, thinking it's underpriced. The solution is a universal ROI framework that adjusts for market-specific inputs, tax treatment, leverage availability, vacancy norms, currency risk, and exit liquidity, while using the same core calculation engine everywhere. This is that framework. Step 1. Gross yield. Annual rent divided by purchase price, expressed as a percentage. A property that costs $200,000 and generates $18,000 per year in rent has a 9% gross yield. Gross yield is the starting point, not the ending point. It ignores all costs, but it's useful for rapid cross-market screening. If gross yield is below 4%, no-cost scenario produces positive cash flow. If it's above 8%, you're likely in a cash flow positive market. Global benchmarks. U.S. suburban markets average 5 to 7% gross yield on residential. Emerging markets like Colombia or Philippines run 8 to 12%. Western Europe and Australia run 3 to 5%. Use gross yield to shortlist. Use net yield to decide. Step 2. Net yield. Gross yield minus all operating costs divided by purchase price. Operating costs include property management fees, 8 to 30% depending on market, maintenance and repairs, insurance, property taxes, vacancy allowance, and any mandatory fees like HOA, condo association, or building fund. A typical formula: net yield equals annual rent, minus property management, minus maintenance at 1% of value annually, minus insurance, minus property tax, minus vacancy allowance at 5 to 10% of annual rent, all divided by purchase price. In a U.S. suburban market with 10% management and 1.2% property tax, a 7% gross yield typically nets 3.5 to 4.5%. In Bangkok with 8% management and near zero property tax, an 8% gross yield nets 5.5 to 6.5%. Step 3. Capitalization rate. Net operating income divided by asset value. Cap rate is preferred over net yield by commercial real estate professionals because it's leverage neutral. It measures the property's intrinsic return regardless of financing. Calculate net operating income as annual revenue minus all operating expenses excluding debt service. Then divide by current market value. Cap rate benchmarks by market tier. U.S. primary cities, 3 to 5%. U.S. secondary cities, 5 to 7%. U.S. tertiary markets, 7 to 9%. Emerging markets with strong rule of law, 7 to 12%. Distressed or high-risk markets, 12% plus. If you can buy at a cap rate above the prevailing mortgage rate in that market, you have positive leverage. Financing the deal improves your return. If cap rate is below mortgage rate, financing destroys return. Step 4. Cash-on-cash return. Annual pre-tax cash flow divided by total cash invested. This is the most important metric for leveraged investors. Total cash invested includes down payment, closing costs, acquisition taxes, legal fees, renovation costs, and initial furnishing if applicable. Annual pre-tax cash flow equals rental income minus all operating expenses minus mortgage debt service. A property purchased for $300,000 with 20% down, $60,000 invested, generating annual cash flow of $4,200 after all costs and mortgage has a 7% cash-on-cash return. In markets where financing is expensive or unavailable, cash on cash equals cap rate. Where cheap financing exists, Japan at 1%, some US markets at 6 to 7%. Leverage can double cash on cash returns versus the unleveraged cap rate. Step 5. Total return analysis. Adding appreciation to the yield equation. Total annual return equals cash on cash return plus appreciation yield. Appreciation yield is estimated annual price appreciation divided by equity invested. In high appreciation, low yield markets like Sydney or San Francisco, appreciation has historically compensated for negative or near zero cash on cash returns. But this creates a speculative bet on continued price growth. In high-yield, low appreciation markets like Detroit or Manila, cash return is reliable, but capital gains are limited. The balanced investor targets markets where both components contribute. Southern U.S. metro areas historically delivering 5 to 7% yield plus 3 to 5% appreciation equals 8 to 12% total annual return. Warning: appreciation is never guaranteed. Underwrite to cash flow. Treat appreciation as upside, never as the thesis. Step 6. Currency and tax adjustments for international investments. For non-domestic investments, your real return in home currency equals local return multiplied by 1 plus currency appreciation rate. If a Bangkok property returns 8% in Thai baht, but the baht depreciates 4% against the dollar annually, your USD return is approximately 4%. Currency risk is the hidden destroyer of international real estate returns. Mitigate with dollar or euro denominated markets. Dubai, Panama, Ecuador use the US dollar. Stable currency pegs: Hong Kong dollar, Saudi riyal. Convertibility, ease of repatriating proceeds. Tax treatment varies dramatically. Japan withholds 20.4% on rental income for non-residents. Thailand charges 15% withholding. Most countries have tax treaties that prevent double taxation for U.S. investors, but you must file Form 8938 and FBAR for foreign property generating income. Step 7. Exit analysis. Total return including sale. Realized return equals the sum of all rental income received during holding period, minus total costs paid, plus net sale proceeds, minus acquisition cost, divided by initial capital invested, expressed as an annualized rate using the compound annual growth rate formula. Exit costs destroy international returns. US, realtor fee of 5 to 6%. Australia, agent commission of 2 to 3% plus stamp duty on purchase. UK, agent fee of 1 to 2%. Emerging markets, higher legal costs, potential capital controls on proceeds repatriation, and illiquidity premium. Assets in thin markets may take 12 to 36 months to sell at fair value. Rule of thumb: in markets with high exit costs or low liquidity, minimum holding period should be 7 to 10 years to amortize acquisition and exit friction over enough compounding years. The framework applied across 5 markets. Market 1, Indianapolis single-family home. Purchase price $220,000, rent $2,000 monthly, gross yield 10.9%, net yield after 10% management, 1.2% tax, and expenses 6.8%. Cap rate 6.4. Cash on cash at 20% down and 7% mortgage, 7.2%. Market 2, Bangkok condo. Purchase price $180,000 USD, rent $900 monthly, gross yield 6%, net yield 5.2% with low tax drag. Cap rate 5. Cash on cash financing not available to foreigners. All cash return equals cap rate. Market 3, Detroit fixer. Purchase price $80,000, rent $1,200 monthly, Gross yield 18%. Net yield after heavy vacancy and management 9.5%. High return, high management intensity. Market 4, Paris apartment. Purchase price $700,000, rent $2,500 monthly. Gross yield 4.3%. Net yield 2.8 after 24% effective tax rate. Negative cash flow property. Market 5, Tbilisi, Georgia. Purchase price $120,000, rent $700 monthly. Gross yield 7%. Net yield 5.8%. Zero capital gains tax, 7% flat income tax, improving rule of law. If you want a downloadable version of this ROI calculator with pre-built formulas for 20 countries, subscribe and check the description. New real estate analysis every week.